Okay, traders, welcome to this live intraday strategy webinar on SB Trade Desk. Today is Thursday, June 16th. We've got about 10 seconds left before the release of US CPI data. We're looking for a headline read, year-over-year core here, to come in at 2.2%, a slight uptick from the previous month. Survey says 2.2. Year over year, headline read comes out at 1.0, slightly weaker than expected. Month on month comes out at 0.2, also slightly weaker than expected. Mixed batch here, guys. I don't think you're going to get too much play off this per se near term. Again, on the near term, month on month, you were slightly weaker. The more important one that the Fed is looking at, the core year on year headline figure coming in at 2.2%. So right in line with expectations. Also, real average weekly earnings. This is a new gauge coming down at 1.1% after a slight downward revision to the previous month. Again, that's a softer read. Remember, one of the Fed's main concerns has been inflation, and specifically growth inflation as it pertains to the labor market. So not necessarily an inspiring read here, but I'm sure everyone's going to be looking at this year-on-year core read as a positive development. All right, with that out of the way, good morning to everyone here in the room. Adam, good morning to you as well. I appreciate that. So I hope you guys had some fun on the FOMC because I'm kind of stumped here on some of these setups, guys. We'll go over the dollar crosses. You didn't get the breakout play. You got a lot of the reaction on the initial move. We were in Aussie dollar. We played a little dollar CAD. But at the end of the day, we're kind of settling out. Some of these trades are basically unchanged on the week. If you look at Kiwi dollar, we're basically trading at the weekly open. The more important trades has been in the commodity block. You're seeing gold with a massive hyperbolic rally after breaking that resistance region we talked about yesterday. You have crude, which is continuing on course off that reversal from the high that we talked about last week. And we'll go over, obviously, the sterling cross as we get deeper into the month and closer to the UK referendum. You did get the BOE this morning was a non-event, essentially. Aussie data last night was stronger than expected, although the Aussie is off today. We'll talk about that. And it's going to pretty much sum it up. As always, guys, feel free. If you have any questions, specific trade setups on strategy or pairs that you want to cover, do feel free to throw them out on the message board. I'd be happy to take a look at that for you. So let's take a quick look at where we stand here on the dollar index. But before we do, I just want to go over the Fed meeting from yesterday, some things that we'll want to take into account now that we've gotten that out of the way. You might have seen me tweet yesterday during the release. It was, in my mind, a precedent. I've never seen a central bank chairman or chair come out and sound so extremely uncertain. You might have seen me joking around saying, is anyone keeping track of how many times she's used the word uncertainty? That's the last thing markets want to hear. Okay, markets certainty is what gives us stability. From our standpoint, it's great for volatility. From the outlook standpoint of where monetary policy is going, certainly puts a big question mark. So if we take a quick look at the updated Fed fund futures, you can see a dramatic decrease in all the expectations for a hike. Now, the first material hike has been pushed out past February of 2017. We talked about this yesterday. This had risen back up to 51%. You saw December come into like 48%. But here we are again, markets pricing out any type of possibility that we'll see the Fed move on interest rates this year. Certainly a major reversal from the last time that we heard Yellen speak, where she was saying with almost a degree of certainty that we are looking and expecting to see, or that she thought moving on rates would be appropriate in the months to come, in the months ahead, quote unquote, is what she said. That being said, if we take a quick look at the dot plot, which is obviously the main highlight of these quarterly projections, you can see basically what we discussed here in the webinar yesterday, guys, is exactly what materialized. You saw the 2016 expectations drop. While the median did stay between 0.75 and 1%, you saw that the majority of the committee fell below that now, okay, with a whole lot of committee members, 6 committee members looking for a print of between 0.5 and 0.75 as we head into the end of the year. So that means the majority still sees an interest rate hike of 1 or 2 or one or two interest rate hikes. That's not what the market's pricing in. So again, you're still getting that divergence between what the Fed expectations are and what current market projections are. Excuse me. So with that said, take a look for the longer running terminal rate for the Fed fund futures or Fed funds, and you'll see again a dramatic decrease here, with now the median dropping from 3.25% to 3%. So that bringing, or that kicking out, I should say, of the interest rate expectations to further date and time, you're looking at the dollar remaining kind of vulnerable here. And we did see that dollar weakness materialize yesterday. Now, heading into today's session, you're seeing the dollar index find some support. And on the daily chart, that's still this longer dated channel formation, this longer dated ML formation that we were looking at for months and months as support. We probe below it, and here's a little bounce. On the 30-minute chart, guys, here's what we looked like yesterday on SB. Kind of messy at this point. Okay, here's what the 30-minute looks like for the dollar index. So we were looking to stay a little bit more of a bearish bias below the New York session high, which is here. Okay, so we're going to continue to favor shorts below 11,911 essentially. I think the level I cited was 11,908, 11,911. Remember, the weekly open comes in at 911. The U.S. session high comes in at 908. So that's right here. So as long as the rally fails or finds some resistance around this region, take a look at the momentum trigger. You have a resistance trigger coming up here. As long as we hold here, I'm going to continue to favor the downside here for the dollar. So a little bit hairy as we continue sort of to pivot along that median line. Again, this is just a kind of a reface of the dollar index that we've been following all week long, but still the same levels as far as the vertical levels or the horizontal levels are concerned. So your major key support still is 11,845, 11,851, basic key 618 retracement. And this is a really nice pivot in price that we've been following, and the weekly open from last week. And that coincides very nicely on just basic trendline support heading into the close of U.S. trade today. So looking for resistance right about here. As it pertains to the euro, as it pertains to the dollar CAD, there are some opportunities of which if euro drops into that, I'm looking for 1165 as an initial target for the short, but I would love to be long from 111.28. We'll go over that in a moment. So it sort of fits in with what we're seeing in the broader dollar crosses. We'll continue to track that closely. But any questions here on the dollar index? Basically looking for resistance. I didn't highlight the region because I didn't want to clutter the chart, but it's basically the New York session high, which comes awfully close to the weekly open at 11,809 or 908. Sorry, a little dyslexic this morning after FOMC. But those are the levels for the dollar index. Now, if we clear this to the upside and invalidate that short idea, you'd be looking for initial targets. I wouldn't get too crazy about 927. I'd be looking for the weekly high and then this region here. You have the 100-day moving average at 11,960, trendline resistance or channel resistance, and a really nice pivot in price into 11,950. That's not the favorite scenario. Favorite scenario is that we find some resistance right around these parts, maybe a stretch higher into that open before we move off. But I'd like to stay bearish, sub 11,911 on the dollar index. Any questions on the dollar index? Again, equally weighted, euro, Aussie, sterling, yen, most liquid currencies. You don't want to extrapolate this against all the dollar crosses, but certainly near term can give us a nice clear movement or a clear view of base dollar moves. Okay, so now that we've gotten sort of the Fed out of the way and some of the implications of what that means, again, I really can't stress to you guys how important that Fed meeting was yesterday. Just the tone that came off. Markets are running with this interpretation in all different directions. Again, I don't. Who am I? I'm no one to make this suggestion, but again, from central bank policy speaking standpoint, I think that was a very poor performance yesterday and led to a lot of uncertainty with regards to not only where the Fed's looking but whether the Fed has a good grasp on what's happening in the economy. And you heard her say, yeah, I mean, we're seeing a slowdown in labor. They reduced their growth forecasts, right? Yeah, inflation forecasts are moving up a little bit on the longer end, but if the dollar is going to maintain this, or let me take a step back, if they're going to kick out interest rate hikes further out down the line, that should be something that would stoke inflation. So inherently, yeah, the inflation expectation would go up, but with interest expectations going down, you're likely to see the dollar continue to remain on the defensive here. So with that said, here's what the euro dollar looks like from last night. Another one that invalidated the immediate upside. On its face value, this had made a clear weekly opening range. There's your weekly opening range high. You made a Tuesday low. Wednesday's rally on the FOMC fails at the weekly opening range high. I wanted to stay constructive near term while above that 1245 level, which is basically the weekly open. And if that broke, we'd look for re-entry again on the long side, down at 111.64. More importantly, 111.28, 111.29. That's the actual June open, and it converges on that median line later this or today, basically. So here's what euro dollar looks like. First on the daily chart. Okay. Getting a little messy with the formation that we're currently trading within. There is that key 111.28, 111.29 level, the June open. As we talked about yesterday, guys, you can extend that range just lower into 111, 200-day moving average, lower median line parallel, former channel resistance, now support, all in this region down here. So if we get a drop here, you would expect to see some sort of inflection, either a nice strong rebound off it, or if it breaks down, sayonara. We're likely to see a lot more losses for the euro. So as it stands right now, heading into the U.S. session, I am looking for some further euro weakness to give us the opportunity to possibly get back on the long side on a move into 111.28. Here's what the scalp looks like near term. And there's that first level of support that we noted, 11.65, 11.64. Okay, so there's that first region of support, median line, and there's the second one down here. So that spike in overnight trade actually did give you the opportunity to get a long exposure. 21 pips is a quarter of daily ATR, failing just ahead of the FOMC rally. That break on, basically near-term exhaustion trade gave us the downfall. And again, through the 200-day moving average, that's the near-term immediate bearish invalidation. We're looking for a low heading into U.S. trade. As a disclaimer, I'm flat on euro. I don't have any positions on euro. I didn't see anything yesterday that was an opportunity to get in. It kind of just rallied. If you guys remember in the webinar yesterday, we were talking about the expectation that we would want to see dollar weakness, but it would be the ideal scenario if you saw an exhaustion blow off before it turned over. That didn't happen. Dollar just tanked. So you didn't really get the opportunity for a decent entry on the release yesterday. I think on this pullback here for the euro, we'll be looking for support, long entries right around these levels. If we hold 111.65 into the U.S. Open and you see a topside pop, would love to get long off of this region. If we see a break further to the downside, 111.28 would be the last sort of region I'd look for euro support. Any questions? Here's what the chart looks like on the grand scheme of things. If you guys need to take a snapshot, do feel free to take that at any time. Okay, notes say euro dollar, look for 111.65 and 111.29. Okay, we're right there at 65 now. Check. Next on tap, I do just want to go through the rest or the last radar chart here, which was on crude. You're seeing crude make headlines today with the weakness that we're seeing. Look, the reversal, we talked about that all week. The breakdown, we talked about that all week. Yesterday, we highlighted one specific thing, and that's the weekly, the monthly opening range low. And a break below that, I think, is really what would validate the reversal trade that we're looking at. Here's what crude looks like right now. You saw that yesterday. While we did close technically below the monthly opening range, I noted that you could get some play off that, right? But you basically want to stay short, or you want to stay a bearish bias below the weekly opening range high, which came in at 49.22. Keep in mind that the monthly open came in at 48.80. Okay, so you have the monthly open and the weekly opening range high. As long as we stayed below that, we want to continue to maintain or favor short exposure in crude. You got a spike in overnight trade that kind of went right into that region, reversed. Or yesterday, we went right into that region of resistance, former slope support, reversed. And again, here's the continuation lower. The first level of interest, and I noted it here, is 46.75, okay, backed by 45.89 and 45.90. 46.75, I didn't want to clutter the chart, but it's right here. Do you see this pivot? The low that we made back here on the 19th of May, and also the actual April high. So that's the first area of near-term support for a scalper. If someone is in this just for a short term, beyond that, the major area of support I'm looking for is still 45.48, 45.98. Again, this is the May open and a basic 236 retracement of the advance from the yearly low. So this retracement right here basically takes into account all of 2016 trade. All right, so outlook remains unchanged. You're bearish below the weekly highs, the monthly open. Near-term support, you're looking for that 46.75. A next subsequent downside target would be 45.48 into 45.98. Any questions on crude before we move off? The first thing I came in this morning as I was looking at the headlines, and lo and behold, you got CNBC saying crude off, I think they were saying 1% so far in this session. Should be no surprise, guys. We broke a pretty big level. And if we do consider yesterday's close below the monthly opening range low a legit break, which I would at this point, since we actually came back and tested former support as resistance and held, continues to give us that downside bias. 46.75 coming up. Any questions on crude? Okay. Let's jump into CAD now that we've been talking about the crude and the losses that we're seeing here. Here's what dollar CAD looks like on the near term. We identified some really nice near-term slope structure here off the low that Jamie highlighted yesterday in the swing update as well. In overnight trade, the trade remained constructive while above 28.31. You remember we've been watching that level for a while. That's the October low. You also have a host of different median lines that converge on that region, namely the lower median line parallel and also parallel former support turned resistance, turned support again. So as long as we stayed above this region overnight, we want to stay on the long side of the trade. Here's the breakout. Now you're coming into a next area target, which was the weekly open from the, May 29th open. Okay, really decent pivot in price. You also have those swing highs from earlier in the May calendar month. Broadly speaking, looks like you could get some exhaustion here. I wouldn't want to play a short. I'd be looking for the pullback to get back on the long side. Initial area of support you'd be looking for is that former resistance. Let me check something out real quick. Okay, some more slope action there. Could be governing it. It's nothing to pay attention to too importantly here, but we'll keep it on there for now. Really, the major resistance or the terminal resistance that you kind of want to take into account is up here. Let me just see if we have any new fibs. 674, 618, 618 we just broke through. And the 786 we've already highlighted right basically at 30.75, 30.72, so I don't need to worry about that either. All right, watch this region here. With the new bullish invalidation level, key support, now at 29.20. Okay, so you look for initial support here at the upper median line parallel, now support. A break below that, this is the bullish invalidation level. I want to stay constructive well above 29.20 here in dollar CAD. Again, with crude where it is, you could see that little bit of an exhaustion trade. So I would expect to see that you could get some pullback here today in U.S. trade before making that new high. But the momentum signature looks very healthy. Multiple bounces and holds ahead of 40. That's very, very constructive. Multiple breaks above 70. So I'm not going to try to fight this one, but rather look for pullbacks to get back on the long side for dollar CAD. You're basically looking for a run back into the upper median line parallel. Okay, keep in mind also, guys, the monthly opens at 130.90. So you have that 130.75 level, and again, just above that 130.90 is going to be the actual monthly open. So right around that region is where you'd expect to see that stretch start to find a little bit more stringent resistance here for dollar CAD. Any questions on the loonie? Keep in mind, event risk for the week is not done yet, specifically for dollar CAD. Heading into tomorrow, you did get the CPI numbers for the month of May. Are expecting a nice uptick there, 0.5 from 0.3% year on year, a downtick from 1.7 to 1.6. But the core year on year, this is the headline read, is expected to downtick from 2.1 to 2, or excuse me, from 2.2 to 2.1%. So, heading into tomorrow's print, if you get a weaker than expected read on core inflation, that should fuel further upside. I mean, unless you get a real strong beat, in which case you could get a pullback to offer some long exposure. You just want to keep that in mind heading into tomorrow morning. I really don't think we'll get too much play, guys, unless there's a major deviation from the expectation here. But on the back of what the Fed just said, it would need to be a pretty big miss either on the up or downside to get major play on CAD CPI tomorrow. All right, moving right along. We are flying through these today. Next up on tap is Aussie. You got some major Aussie data yesterday with the employment numbers. Here's what those look like. Employment change for the month of May came in at 17.9 thousand. Okay, we were looking for a print of 15. The major thing that people took away and some of the initial bearish reaction that you're seeing is because of the downward revisions that you saw. Last month's 10,000 read was downwardly revised to just 0.8. On the bright side, you did see unemployment hold at 5.7 as expected, but even more so, let me take that back. You did see unemployment hold at 5.7%, even though you saw a hold. We were expecting an uptick in labor force participation. That held at 64.8 as opposed to coming in at 64.9. So you didn't see growth in the broader labor department or labor force as a whole. You didn't see much full-time growth, 0 jobs in the full-time sector, with a contraction last month being downwardly revised to a bigger contraction. So overall, it was a weak read. The major highlight people walked out with, first of all, was the major beat on the employment print. But as you look deeper into the metrics, didn't look all that good. So for the Aussie dollar, what's the implications? Here's what Aussie dollar looks like on the daily chart. If you guys remember, we've been talking about 73.60 for some time now. It looks like we're breaking below, and that puts the focus down on subsequent targets at 73.24. Oh, which I think we just hit. Oh, not yet. We'll highlight the 30-minute in just a moment. And 72.82, which is going to be the 2016 Open. Now, it just so happens that this 2016 Open converges dead on with a 618 retracement of the advance. So that's sort of the major support. Just below that, you have the 200-day moving average, 72.68. So it gives you a 20-pip range of critical support for the Aussie near term. By the way, this is just historical SSI. You can actually download this, I think, now, guys, from FXCM. I'm not sure if they've released it to the retail trade group yet, but it's pretty cool. You can bring it up on your charts. More importantly here, you just see where you can, it's easily identifiable where SSI has switched from net short to net long or vice versa. And also a nice tell can be decreases in net longs or decreases in net shorts. Can also tell you something about momentum waning. So what I wanted to say is traders remain net long here, okay, which is typically a contrarian indicator suggesting we should continue to look lower. We are not near extremes in SSI, and we've broadly been just holding this level. So I don't want to stress it too much, but with that reading where it is, not too surprising to see Aussie come off a little bit more abruptly. So here's initial support, 73.23. This is a 50% retracement from the advance, former channel resistance, and now support. And this is sort of the first level that we'd want to find, possibly some support here, some settling for the Aussie dollar. Do keep in mind that this is the weekly opening range low. Okay, so we're basically testing the weekly opening range low at this point. And a break below that, there's that key Fibonacci confluence with the 2016 open at 72.82, 72.81. So again, it's one of those things, guys, where either we need to see a more concerted drop and a hold into this critical level. For me to start getting aggressive on the long side, I'd need something pretty hefty. I do like getting long near the weekly opening range lows here, but with what the dollar is doing and with the data that we got, if the U.S. reaction as we open breaks this level, I think you find settling deeper down near 72.80. Also, now that I'm just looking at this, give me one sec. Let's see if we have any structure here. Yeah, it's not the neatest thing. It's not the neatest thing. We'll come back to that. That works, though. Okay. Any questions on Aussie before we move off? Interim support 73.24, 72.80. Resistance, look for the Asia high that we made last night, or this is actually the London high that we made last night. And really, to get back on the longs or to validate the reversal, we would need another break above 74. Keep in mind this. Yesterday when we got the FOMC, this break constituted a break of the weekly opening range high. So I actually got long with that break, with a stop against the low. We were able to attain a 25 pip advance on the initial spike. On the pullback, I got long again. And an overnight trade heading into Aussie trade, I actually ate the full stop. So I took a null, flat gain yesterday for all the Aussie scalping that I did, just based on the losses that we saw on the employment report. So a little frustrating on that end, but long story short, with what price action is doing off that high, if we break lower, keep that level in mind. Keep that level in mind. I'm still looking for settling in the Aussie to get long. It's just that on this reversal, you're likely to want to make a new low before you start to move off again. Okay, so looking for a low to buy in Aussie dollar. Moving right along, British pound. You did get some stuff out of the UK. With the BOE this morning and retail sales. So retail sales came out better than expected across the board. You saw ex-auto and fuel year-on-year headline read come in at 5.7%. You even got an upward revision for the previous month on all three accounts. So certainly the data was pretty good. The BOE held as expected. No major commentary there to shift the ball for pound. You might have seen also this morning there was a release that there was a new betting poll that came out that showed a 60% likelihood that the UK will stay. or will vote to stay at the referendum next week. These polls will continue to shovel in as we get closer to that read. I'm sure you'll get some over the weekend. I'm sure you'll get some early next week. So just be aware, when those come out, you'll tend to see a lot of volatility in the real near term. But here's what British pound looks like on the 30-minute. Okay, first of all, let me go back to that daily. The main thing that you want to just kind of be mindful of here is the fact that we're back within the confines of this long-standing formation that we followed for almost 2 years. Okay, so that leaves the major resistance sort of right around that area, 42.30. The 42 handle turns out to be the 618 retracement of the advance. So near term, that's the level of resistance we would need to clear to get constructive. As far as the sterling is concerned on the scalp, let me just snap these levels. There we go. Okay. As far as the levels are concerned on the scalp, the immediate resistance also reflected here at 42. Again, there's that median line for the near-term slope. 618 retracement. Yesterday's session highs for the United States come in just higher at 42.08 or so. So that's the level of resistance to beat to get the reversal trade. And this point, if you do get that pop, look for a rally up towards 43. Gives you a nice 100 pip move. You're only looking for about 37 pips, so trade that accordingly. But this is the region, this is the high that we need to clear to get the play back to the upside for the pound. I just want to say a disclaimer, guys. I've tried to scalp this thing this week. It's been like pulling teeth. Keep in mind, when you're trading something like this right now, it's really, I don't want to say a fool's errand because I'm basically calling myself a fool, but just stay really nimble, okay? You have such major event risk and everyone's fixated on the referendum. And specifically now that the FOMC is out of the way, right? We know there's not going to be higher rates in the U.S. anytime in the next month or so. So all the focus falls on this referendum deal and the implications not only for the pound, but for the euro, for the Eurozone economy, for the euro project, and for global growth. So just be careful trading all these sterling crosses. You might have noticed that Jamie is also kind of gearing away from trading these sterling at this point in time. Again, we're only a couple of days away from the referendum, so keep that powder dry and stay nimble if you are getting involved in these trades. That being said, I'd have a similar outlook on this as I do on the euro. Maybe not as aggressive, but I would be looking for that final drop into 40.60 or so, basically making a new low to be able to give us an opportunity possible to find some settling and some support near that 764 retracement. Any questions on the British pound? Keep in mind one other thing is that the weekly opening range is still intact. Here's your Monday, Tuesday stretch. Weekly open, stretches into a low. Tuesday high, you've been trading within that range ever since. So even on a weekly standpoint, an objective range play is in focus here for the British pound. Just keep an eye on this resistance trigger here. Okay, so if there are no other questions on the pound, I want to take a quick look at the Kiwi, and then we'll dive into gold real quick. And if there are questions that you guys have, please feel free to post them on the message board. Here's what gold looks like, or Kiwi looks like rather, on the daily chart. There's really not much to talk here. We've been covering this all week long. The main range in focus is still 71 into that key support barrier between 69.70 and the 70 handle. We've been trading basically bouncing off that for the week. Momentum peaked out right at former support, which was a 4-point trigger as resistance. Looking at the Kiwi on the 30-minute, here's what it looks like. No change to any of our levels. But one thing you do want to notice this. So here is your weekly open, okay? You basically broke the weekly open, you challenged it to the upside, failed at the weekly opening range highs, and now you're breaking back below the weekly open. This is a range, okay? Now, as it pertains to structure, we are drifting out of it, so it keeps the focus on a scalp basis more so on a rebound or a push lower before you rebound to a new high. But if you zoom this out long enough, That's the level you need to pivot below to get bearish, super bearish, or to sort of give you the reversal trend. We haven't gotten it yet. We haven't gotten it yet. So look for some near-term resistance again near the weekly open. I really, again, haven't had many positions here on Kiwi for the week. I thought this was going to be a nice break. Turned out to be a really nice long exposure. We talked about this yesterday with a clear-cut trigger. This was like a gift. But on the rally yesterday, really just fizzling out near the weekly opening range high, pulling back, and then coming into the weekly open puts me on a neutral bias for this right now. Hey, Mir says dollar yen. Are we still bearish? Also, could you take a look at dollar Swiss? So, dollar yen, as you know, I haven't been following it. I know that the low that we made last night, let me see my notes here. I think I had a level down there. Mir, is it 2000, 2002? 2013, excuse me, May 2013 high. That was at 1370 or 103.70, excuse me. So, look, for dollar yen, this is all I can tell you, Mir. From a near term trading perspective, there's nothing here for me. When we look to set up the near term trades, guys, you want a trade that has had price in that range within some sort of um, recency. And what I mean is, you don't want to be scalping, in my humble opinion, a trade that is heading into territory not seen for like a year, 2 years. This becomes a lot trickier to trade because you don't have much price reference to play with. In that, to help you define these scalp levels on the near term, previous price is what we use. Whether it's an extension, whether it's a retracement, whether it's just a horizontal resistance or support. But once you get into these new extremes here that we haven't seen in over a year and a half, this is 2014, last time we were down here, I really don't have much. I really don't have much. So for me, I don't have a very strong opinion on this. I would actually be looking, Mir, for a decent rebound here, possibly to give this thing some play. But broader picture, in my humble opinion, again, stays bearish below basically 106.50, this region right here, which is the low day close for April, the close low for this massive day drop that we had on the 3rd, and a broader dated 38.2 retracement. This is from the advance off the 2012 lows, I want to say, 2011 low. All right, Mir, I hope that helps, man. I wish I had more conviction for you on this one, but dollar yen sort of beating its own drum right here. And again, BOJ did nothing yesterday. There was a whole lot of talk and rhetoric of which I don't even want to get into. But I think a lot of what you're seeing here are bets that, well, let's take a step back. The Fed's commentary yesterday, the dot plot, Yellen's remarks, really makes things very difficult for the BOJ. Okay? And it kind of ties their hands. And essentially, these are bets that they will not work further to devaluate the yen at this time. Right? And you're seeing the yen give us some strength here. So, exacerbated by what we saw yesterday as it pertains to the dollar, here's the result. Let me highlight that level for you on this daily chart here. As far as dollar Swiss is concerned, Mir, let's take a look what that looks like right now. Oh, okay. New low for the month. Nice hold in momentum. Outside day reversal. If we close at these levels, obviously we haven't even opened the session yet here in the United States, but if we do post an outside day reversal today, it would be an outside day reversal off support of a fresh monthly low. That to me would be a near-term upside bias. Let me take a deeper look here at the 30 minutes. Okay, we're working with a slightly different slope on this 30-minute chart, but I just want to check some stuff out, guys. Mir, bear with me just for one moment. Okay, so right on its face right now, Mir, looking at this for the first time this week, I would say that this is making an opening range reversal trade. So what that is when you have a really well-defined preset opening range for the week, you get a false break of the opening range low before reversing and taking out the high. It's a classic opening range reversal, and the fact that it's happening on an outside day off support, for me, does put an upside slope on this near term. Now, how far that goes is a whole other story. Let's see what near-term retracement off the high looks like here. And then we'll see if we have any slope on the ascent. Yeah, it's way too early to get any slope off this ascent yet. So I'd be using this as a constructive trade above the weekly open at this point. And the weekly open on this one comes in at the open 96.31. Oops. So heading into the close of the week, basically tomorrow, Mir, I'd be looking constructive above 96.31. Subsequent topside targets Pretty much self-explanatory here. A basic 38.2 takes into 97.17, then 97.60. A quarter of the daily ATR is really tight here. Just keep that in mind. You're looking at only 17 pips per scalp on a daily basis. But I think this constitutes a break of the weekly opening range. I mean, you're going to have to reassert this on the open of U.S. trade. If we head into the U.S. trade session, this reverses course and goes back sub 96.70, 96.60 here, that would invalidate this near-term bias. But this is a peak high that we made in momentum. Multiple holds at 40. Did see a slight dribble here, but again, on a weekly opening range reversal, that's to be expected. Also, keep in mind that that first level and the opening range high for the week offered a really nice pivot in price back here as well. So that break even adding more so conviction on this being a near-term reversal in the Swissy. I wouldn't get too excited about the long side until you get some slope. I think it's really early to be even looking at this slope, but if we do, it kind of also highlights that basic 38.2 retracement right up here, near term. And again, 96.30 would require or necessitate a break back below the median line. So it sort of jives well as far as having a strategy to trade this. But that's what I'd be looking at for Swissy near term. Mir, does that make sense? Maybe you can look for a scenario where this stretches into 97.17 on the pullback. Again, look for support along the weekly opening range high, along that median line. But broadly speaking, looking higher above 96.30. Mir says yes. All right. Yeah, so feel free to take a snapshot of that if you need it. Okay, gold went hyperbolic, essentially. And here's what the daily chart looks like. So remember, 1291, 1293, 2015 high week close, the May open, essentially, the May high day close, all was in that like $3 range between 1290 and 1293. We peaked into that right into yesterday. I actually gave you guys a tweet as we were tapping that and pulled off. In overnight trade, as you got into Asia session, this thing again started to rally and rip. And here we are, momentum at its highest levels that we've seen on a daily basis since February. And price touching or hugging that 200-week, 200-week moving average. Right now, currently at 13.13. Today's high so far, 13.13. All right, so again, one of those trades now. Keep in mind this, guys. As far as consecutive bars, we've now marked 6 days of consecutive advances. Today is not counted, so after we close this candle, it would be 7 days of consecutive advances. It's been quite some time since we've seen that many advances. Here's the last time we saw it. It was a stretch high that gave you a 3-day pullback before finally completing another high. Prior to that, you got to go back quite some time. That was in a strong uptrend, showed no pullback. That was in a bottoming process, and you saw a decent pullback. So long story short is you don't get that many consecutive bars or consecutive advances in a row that often. And that suggests that something could be happening on the near term, either an exhaustion trade on a spike into slope resistance, or on a decent pullback here, you want to stay on the constructive approach because this is a broader uptrend. As it pertains to what happened yesterday and why this rallied, again, you got to keep in mind this. If the Fed is going to keep rates lower, the implications are two things. We're trying to stoke inflation, and people are searching for yield. They don't want to get in stock markets because, in my humble opinion, stocks are extremely overpriced at this point. And with the same respect, if the Fed isn't moving on rates, that means they're concerned about the broader global growth. They're concerned about what's happening with the Brexit. They're concerned about what's going to happen with, the Brexit's probably the biggest thing on the horizon, but even the China concerns, guys, aren't going away. It might fall out of the headlines, might fall out of the forefront, but there's real material problems happening over there. So that suggests that the central bank remains concerned. And certainly with the word uncertainty being used 100 times yesterday, it's no surprise that people are seeking the relative safety of gold. So I would be looking for some near-term resistance here, just higher. You do have that slope line for the operative trend we've been following. Next upside target is 1334, and that's the 2014 high week close. We're talking some pretty big levels here. Here's what the weekly chart looks like for gold, by the way, just to put things in perspective. And there's that 1334 level, is that high week close. Not only is the high week close for 2014, it was this massive outside week reversal off of key resistance that we made in March of 2014. And the close right there was 1334. Coincides with basic channel resistance heading into next week and the following week. So keep that in mind here. But it's been a pretty major reversal. Pretty major reversal. I still think that near term you're looking for exhaustion. If you're looking for a fresh trade on gold, now is not the time. On the long side specifically. Now is the time that you start to look for some exhaustion, look for that pullback to get back on the long. But for me, I'm not interested in trying to scalp gold on the long side from any standpoint at this juncture. All right. That's all I got, guys, for today. Probably going to be pretty light as far as new trades heading into the end of the week. Again, major event risk next week with this whole Brexit thing, so keep that in view. Don't forget, later today, 1 p.m. Eastern, Jamie Setley will be on with the midweek strategy webinar to go over some of the swing trades and some of the longer-term positions he's looking at. So don't miss that today at 1 p.m. Eastern. If there are no other questions, guys, we'll go ahead and wrap the room here. Have a great weekend. I will see you bright and early on Monday morning. Remember, Monday's the public webinar on Daily FX at 8:30 Eastern, and then right back here on SB Tuesday, Wednesday, and Thursday, 8:30, same time. Till then, best of luck trading, and I'll see you next week. Cheers.